on the state of on-chain credit and just some background on myself. I started my career in the crypto industry at Masari about 4 years ago, worked on a variety of different research teams there, and then recently joined Serotonin 3 months ago to head up the research function. Historically, we're a PR and marketing agency in the crypto industry, and now we're expanding to offer sort of a white label, a research as a service for our clients. And the first task that I had at Serotonin was to write kind of a proof of work of what we can offer on the research side, and that was on the state of on-chain credit. A lot of our partners work in on-chain credit. It's a space that has been growing tremendously and is one that we're very bullish on. So spent about 2 months writing this report, which of course I'll share with you guys eventually. But for now, going to go through a lot of the data and charts that are in this report, some of the key players within on-chain credit, and really just tell the story of what is happening across on-chain credit today. So first of all, just a landscape of the market today. We're in a bear market in terms of crypto assets, but our real world assets have continued to grow despite that. You can see all the different asset classes within RWAs continuing to trend upwards, over 100% year over year growth for non-stablecoin real world assets. So despite the broader bear market, RWAs continue to grow, and credit has been the fastest growing one, 630% increase year over year in terms of the market cap of on-chain credit. So big growth story. And just to step back in terms of traditional private credit, and credit, by the way, is simply, you could think of it as a loan, right? Someone taking capital and extending credit, giving a loan to another party. And back in 2008, when the global financial crisis happened, controls over banks and their ability to lend and what they do with their reserves got tighter, got more strict with some of the regulations that came out post 2008. And so a lot of lending and credit started to transition to become private. So private equity funds or insurance companies with longer durations to be investing in, they started extending credit more and more. So you can see that growth story here in this chart. Less than $1 trillion in private credit back in the late 2000s. And now that's grown to $2 trillion, just a little under. And the estimate across various institutions is that this will continue to grow nearly 2x to around 4 trillion by 2030. So traditional private credit is on a big growth trend. And the same can be said for on-chain credit. Massive growth. That on-chain credit basically didn't exist in the early 2024. And now throughout 2025, it hit a massive growth spurt. It's the fastest growing real world asset class, and up to around 6 billion in market cap today. And just some context for why this is growing. Obviously all RWAs are growing at a rapid clip as more of traditional finance comes on chain. But what credit is able to provide is higher yields than a lot of benchmark rates. So when you talk about the average DeFi lending rate or US Treasuries, this asset class presents higher yields than that. And so that's why these assets are continuing to come on chain and are seeing traction. So to get into some of these on-chain credit assets, there's a wide variety of them. One of the most simple to understand are institutional credit funds. So there can be a fund, and someone like Apollo is the one that's underwriting and originating loans to different borrowers. And those are then kind of wrapped in a fund. Similar to private equity, right? And some of these venture capital funds we see in crypto. So these funds are starting to be tokenized. Janus Henderson's JAAA is the largest one at the moment, followed by Apollo's ACRED, BNY Mellon with Stack, Fasanara's MF1. So these are still barred to KYC institutional accredited investors. So these aren't products that retail or just the broader public can access. But there is a lot of crypto native capital flowing into these. And part of that story is growth finance. This is part of the Sky ecosystem. If you guys are familiar with that, it's basically a sub-DAO or an agent, they call it, where they tap into Sky reserves and invest it into longer duration, higher yielding real world assets. So a lot of this is in US treasuries, but as you can see, they're the largest investor in JAAA, also Stack. So Sky's a big player in capital allocation, crypto native capital being allocated to on-chain credit, and particularly the tokenized fund asset class. Figure is another one. This is actually one of Serotonin's clients that we work with. They're a publicly traded company, around $7-8 billion market cap, so a significant company. And what they're doing is using the blockchain and tokenizing home equity lines of credit, or HELOCs. So when you build up equity in your property over the years, you can then borrow against that equity. And what they've done is use blockchain technology to disintermediate that process to the extent that they're able to save around 120 basis points in per loan costs. So big cost savings that then flows into their bottom line, and it can also be used to make the product or make the borrowing rate more attractive to their users. So just generally a good business, and they have now become the largest non-bank HELOC lender in the United States. So a lot of traction. And what I really like about this, and you guys being in the Solana ecosystem may have heard about the Prime asset, which is issued by the Hashtra protocol. So when you originate a HELOC, you need to give money to the borrower immediately, but it takes 30 or 40 days to actually securitize that instrument and then sell it to another party that then is going to hold it for the entire duration. So in that 30 or 40 days, Figure needs the capital to lend out immediately. And they've opened up that opportunity to the broader public through Prime. So on Solana, you can purchase Prime. That capital is used to, again, facilitate that loan over those 30, 40 days before Figure sells the loan. And that is yielding around 8%. And anyone can access it. You can leverage it in DeFi. So Prime has seen a ton of traction. It's used a lot on Camino, on Loopscale. And yeah, just overall Figure's doing really good work in the on-chain credit space. Maple is another one. You've probably heard of this one. It's been around for a while, but really grew a ton in 2025. What Maple does is, again, take on-chain capital through, in this case, the Syrup USDC and USDT token that they have that's DeFi composable. And the capital that Maple Finance has is used to extend credit to institutional crypto native borrowers. And those loans are backed by crypto native capital. So say an institution has a bunch of XRP or Bitcoin or SOL that they want to borrow against, they can leverage Maple Finance to take that loan. And on-chain users, on-chain capital can benefit by, as of right now, Syrup USDC yields around 4.5%. So just democratizing this opportunity to extend credit to institutional borrowers, and generally it's pretty safe as the loans are over collateralized by this crypto native capital. So big traction, 1.8 billion in TVL, around $1 billion in active loans. And this is another asset that's used quite heavily on Morpho and Camino to borrow against. Kappa is another one that's an emerging competitor to Maple. It's not on Solana at the moment, just Ethereum. But what they do is similar in effect, where the capital is used to extend credit to institutional borrowers, but the method of collateralization is different. Borrowers don't need to post any collateral in this case, and instead, an underwriter uses typically restaked capital to secure those loans. So if an underwriter is willing to underwrite Falcon X or whoever it might be, they can use restaked capital and essentially secure that for the lender. So this is helpful for the borrower side because they don't need any capital that they post for the loan. They can have $0 in capital. They just need an underwriter that they have a relationship with or that is willing to underwrite that risk. And again, the lenders in this case, the depositors of CAP protocol, they benefit from earning this yield through CAP's STCUSD token. So still small in comparison to Maple Finance, just $100 million in TVL or so, 50 million in active loans, but growing quite rapidly, particularly in the utilization rates of the capital they have. So there's borrowing demand that's continuing to increase for CAP. USD AI is another one. I quite like this one. Made a lot of noise a month ago or so with the launch of their chip token. So what USD AI does in on-chain credit is, again, like all the other protocols, pooling on-chain capital. And in this case, it's used to finance GPUs. So USD AI is underwriting, not necessarily a borrower in this case, but just the GPUs that are being purchased, because the loans are backed by the GPUs themselves. So let's say some AI company or whoever needs a GPU, they can tap into this pool of capital, say we want to purchase a GPU, and then USDI can underwrite that, extend that credit, they get their GPU, and USDAI is then, and depositors are earning yield with that loan being paid off. And in the case of default, there's always the GPU that they can then secure and sell off if they need to. So this category is called infrastructure finance, or InfraFi. It's a growing one. Asset-backed finance, actually, in traditional private credit is super hot. Folks like Apollo are talking about it a ton as one of the largest credit types, and it's expected to continue to grow a ton. And when you think about the AI build out, USD-AI is positioned pretty well for that. And there's others like Daylight and Dawn that are doing a similar model, but for solar energy build out or battery build out. Again, two infrastructure categories that are expected to continue to grow a ton over the coming years and decades. Credit Coop is another credit issuer. In this case, they work with credit card issuers. So Rain is a company that's been having a lot of success, and what they do is issue credit cards to their partners. So for example, EtherFi has their credit card product. That credit card is issued by Rain. And when these credit cards are used, the money has to be given right away to the user of the credit card. That is then paid to the merchant, right? And they have a month to pay that back. But the thing is, for the credit card issuer, they need to repay Visa immediately, the same day. So where do they get that money? Well, they can tap into Credit Coop, which pools on-chain capital, and then Rain taps into that capital, pays Visa, and then eventually pays that back to Credit Coop with a bit of yield on top. So another model of on-chain credit. think this is the last one that I cover. But as you can see, it's super diverse on tokenizing credit funds, large credit funds, infrastructure finance, payment finance here with Credit Coop and others. What else? Institutional over-collateralized borrowing. There's a lot of different types of on-chain credit and ways for regular users like all of us to access those opportunities in a way that isn't typically possible without these things being on-chain. So going back to my earlier point about on-chain credit yields, every single one of these assets is yielding above benchmark rates. So the average DeFi lending rate is super low right now, around 3%. US Treasuries are at 3.7%. Sky Savings rate, 3.8%. And even the DeFi borrow rate, the on-chain credit is yielding higher than all four of those benchmark rates. So that tells the story of these assets introducing exogenous yield that isn't correlated with the broader crypto market. So historically, money market activity is tied to leverage taking in DeFi and crypto. And if there's a bear market, the demand for borrowing, demand for leverage goes down, as we're seeing right now with the DeFi supply rate. But as these on-chain credit assets come on-chain, sources of those yields are not tied to the crypto market. They're tied to trade finance or infrastructure buildouts. And so those rates can stay higher basically indefinitely, and it just increases the demand for money markets like Camino and Morpho. And it also pushes lending rates higher, because if an asset is and its yield is uncorrelated with crypto, there's always going to be borrowing demand, borrowing activity for those assets, and it just generally pushes the lending yield higher. So I'll cap the presentation with some charts on money market activity, and this one is on vault curators. So in the model of Morpho, of Camino, there are these curators that are now the ones that are underwriting essentially the assets that they're willing to lend to in money markets. So Stakehouse is one of the largest ones. So yeah, just a chart to show some of these vault curators: Stakehouse, Gauntlet, Centaura. And when it comes to money markets, a lot of these on-chain credit assets are being used there. So Maple is one of the biggest ones on Morpho. CAP, which I mentioned, Fasanara is another tokenized credit fund. USDAI, which used to be a lot larger, now it's gotten smaller in terms of money market activity. But when you think about an asset that's yielding at whatever it might be, at 5-6% or even 8-9%, that then presents the opportunity to borrow against that asset. It's still yielding above the borrow rate. You get capital to use for whatever other strategy you may like, but it also presents the opportunity for looping. So if you're comfortable with that asset and the yield that it's providing, you can borrow at a rate that's lower than the yield and leverage that yield up. So this is happening a lot with Falcon X. So I didn't cover that asset, but essentially it's yielding 9% or so. You can borrow it for 5-6%, and if you loop that up, you can leverage that yield up to 20-30% if you're willing to take that risk. Camino, similar story to Morpho. They have less markets, but they are generally larger. So figure this is the Prime token. A ton of activity there, borrowing against Prime and also looping it up. It's a strategy you guys may have seen on Twitter, heard about. But again, when that asset is yielding 8%, you can borrow against it at 4%. You can then leverage that yield up. And notably, Camino is doing super well actually when it comes to on-chain credit. I believe it's larger than Morpho, their on-chain credit markets relative to Morpho. So a lot of good traction on Camino in regards to on-chain credit. Prime actually did just launch on Ethereum and on Morpho just this week, so we'll see how that ends up growing. But it's a nice competition here between Morpho and Camino in on-chain credit markets. So that wraps the presentation. I'm just going to wrap it up with this on-chain credit market map. Feel free to reference it and reach out if you have any questions or are curious about any of these protocols. Looked into all of them in the research process and ended up categorizing them across 4 categories. Credit issuance, which we covered a ton. You see Maple on there, Cap, Astra, but there's lots of others. Capital allocation as well on the curator side, growth finance, and then also yield-bearing products, which allocate to on-chain credit as well. And then risk management is the last category. Tranching, risk coverage, liquidity, risk analysis. So on-chain credit is really an expansive space, a lot bigger than I had imagined when I set out to write this report. But yeah, that wraps up the presentation. Dziękuję bardzo wszyscy, and I hope you guys have a better understanding for what is on-chain credit. It's going to only continue to grow, in my opinion, so you'll be seeing it a lot over the coming years, and hope it was helpful and provided some background on this asset class.